But Stuart, we want to start with you. Fed Governor Myron is advocating for 150 basis points of cuts in 2026. Do we need that? Would that make a difference in the labor market? And is that what needs to be targeted when it comes to the Fed?
I think 150 basis points is way too much. I think that it really assumes that policy is super restrictive right now. But when you look at, let's say, credit spreads, when you look at asset valuations, when you look at household bankruptcies, when you look at credit card delinquencies and auto loan delinquencies, it's pretty clearly the case that monetary policy is not so restrictive that 150 basis points of cuts is warranted. I think that when we then look at the labor market, it looks to me like a lot of what we're seeing, the slower absorption of labor by firms, it looks like that's mostly due to a structural rebalancing rather than cyclical weakness. And when that's the case, again, why rush to make cuts? Why rush for 150 basis points of cuts this year?
Alli, you're nodding. I see you. Come on in.
Well, look, I mean, I think there are two things.
You don't have to agree with Stu just because he's next to you.
Fair. First of all, the relationship between monetary policy and the labor market is tenuous at best. Second, inflation, as they said, is exactly where they think it should be, and that seems to be proven out. And the cyclicality has been significant. Part of why we are where we are right now in terms of market highs, in terms of things like where precious metals are, is because growth has surprised to the upside again and again. And you're seeing that, and to tie this all together, you're seeing that in productivity. When you look at the 18 companies that have off-cycle reporting and have already reported full year and third quarter, they are beating by, as done in the third quarter, about 2 times what the street had expected. So they're beating at about 14%.
So things are pretty
and
good.
Not on revenues.
Yeah.
Not on revenues.
Okay.
On productivity gains, on margin. And so things are pretty good. There's a lot of noise. A lot of it's coming out of DC, like moment by moment, but things are good.
Well, that noise from D.C., Stu, and we talk with you and we talk with Alli about this. I mean, we think about yesterday, all of the social media from President Trump, whether it was on the housing market, whether it was on defense companies. There's a lot, everything that happened in Venezuela, which makes you think, okay, what geopolitically next might happen? How do you continue to pull that in? And Alli, we're going to ask the same of you. How do you continue to pull that in and factor it into maybe economic projections, or do you not?
Well, we do. We do think that there's going to be a considerable amount of fiscal tailwinds that support growth throughout 2026. We do get a lot of noise when it comes to things like housing policy. And then when we factor in something like a banning of institutional investors from buying homes, we then have to think about the knock-on consequences for home valuations, for household wealth. It starts to get very tricky. So we're sort of moving at the pace of policy as opposed to at the pace of rhetoric. And right now, where we see the policy stance is that deregulation, fiscal tailwinds are going to support growth throughout the year. And again, when that's the case, no need to rush for cuts.
Alli, what about when it comes to more spending from the U.S. government? What if the president gets his wish and sees an additional $500 billion in the defense budget up from $1 trillion?
Well, then we have a couple issues because there's both sides of that trade, right? So then we have increased fiscal tailwinds, which are already, through the big beautiful bill, which are already sort of myriad, and we've seen them already in a sense.
You're talking about the deficit
and
just
then
spending.
You have the deficit,
yeah.
Right? So all of these things play together, and I think to your point, right now you have to invest on Fed directionality, not magnitude, earnings, which is going to be significant this year, probably 10 to 12%, and much more broad. Well, when we say much more, there are about 10 companies that made up 50% of the earnings in 2025, and quite honestly, the year before and the year before. Now they're going to grow at about 22%, while the rest is going to grow about 4 or 5%. But believe it or not, there is some more breadth to that. But those are the fundamentals you have to invest in. And then you have to understand that this concept that has been coming out of Washington the last couple of days, which is affordability, is a big deal because midterm elections are this year. Mm-hmm. And so there is going to be a lot of policy put forward, a lot of rhetoric, and it's almost going to be like a live action show for the next number of months, seeing what happens between Trump and Congress, what happens in the Fed, and sort of figuring out what of these are, could happen 100%, what could happen 0%, and
Right.
what's happening in the middle.
Stu, you've been looking at the midterms, right, and doing some kind of in-house calculations a little bit about whether or not we might see a GOP pushback, or maybe it won't be as strong as everybody's expecting.
Yeah, Alli brings up an interesting point about just how much affordability has been at the forefront of people's minds, including for voters. When we then take a macroeconomic perspective and we think about what really matters for voters, as much as they're focusing on affordability, because it mattered for the Mamdani election in New York, what seems to matter most are things like inflation, playing into affordability, and improving living standards. And when we then model out what the change in the structure of the House of Representatives is going to look like after the midterms, it actually doesn't look like voters are exactly rushing to flip the House. Right now, the betting markets are assigning about a 70% probability that the House flips to Democratic control after the midterm elections. But when I model out control of the House based on those major economic variables, inflation and standard of living, it looks like just about 4 Republican seats will flip. Again, this is very top down, and when you look at politics, you really need to go bottoms up from the congressional district and really understand how people are living district by district. But it doesn't exactly look like it's a mortal lock that the House is going to flip. It actually looks like it's going to be much closer in the president's favor in the midterms than betting markets are supposing right now.
So, Alli, bring it home to the markets for us and to where you're advising people to put their money.
Yeah, so this year I called my last note lather, rinse, repeat. Over the last 2 years, you've seen the same thing. You've seen decreasing interest rates helping bonds and equities. You've seen equities doing extremely well. Actually, last year, U.S. equities were dwarfed, in a sense, by non-U.S. equities. And you've seen commodities, for a whole host of reasons, including the dollar, including geopolitical risk, increase. I expect more of that to happen this year, because I think what we have is the same levels of support and growth, Fed directionality, fiscal tailwinds, AI, but we also have another, that GDP keeps on surprising to the upside. And so really there are a lot of tailwinds, and I also call it like fear of heights right now. It's hard to want to invest in these things, but there's reason to be bullish.
We got about 30 seconds left for each of you. Alli, I just want to ask you, were you making investment decisions based on what President Trump had to say about institutional investors not buying
Absolutely
housing
not.
Or about defense?
Absolutely not. We make investment decisions based on the fundamentals of stocks, companies, and the macroeconomy. When and if that changes, and these things could markedly change that,
Right.
then we would make maybe tactical changes where we would overweight defense in something,
But
like
not on
that.
a tweet.
But in terms of absolutely, that you'd get brain damage from doing that.
25 seconds left for you, Stuart. Are we going to get brain damage coming off of the jobs report tomorrow? No, just real quickly, what do we need to know?
No brain damage. I'm expecting 80 to 100,000 jobs added in the month of December.
Feels low.
It feels low if we consider, the post-COVID hiring boom, but in the context of the break-even pace of hiring, that's about double the pace needed to maintain a steady unemployment rate. 80 to 100,000 jobs would be a very good jobs report.